All right, welcome. We're going into chapter 4. Let me get my dongle going here, see if we can do it this way. So we're finishing up risk management here, this chapter. And I've been doing a little bit of work on the notes to try to rearrange the subjects so that they're in the right order. Boom. Let's see if it's going to do it. Yes, it works. Boys, it's wonderful when things work fine. All right, so basically we have a number of topics in risk management in this chapter that aren't really covered in the first 3 chapters, so it's kind of a hodgepodge of topics that we'll get to. So we talked a little bit about enterprise risk management, and back in the 90s, the job of the risk manager broadened from just looking at pure risk, which involved primarily insurable items, to considering all risks faced by an enterprise. So it became a bigger job than just let's hire the insurance guy. Okay? So to address all the risks firms face, companies developed ERM programs. And so you're going to see out there in the literature that term ERM. And that's what they're talking about, enterprise risk management. And some organizations created a chief risk officer, okay? And it's a really important position. And it's still relatively new, so there's a challenge with the job of getting the other big managers to listen to the risk officer. I know this was a real problem on Wall Street back when we had the financial crisis. The risk officers did their very best to try to steer the firms away from taking these big risks with these securities. But the more powerful people in the company who were making a lot of money, generating a lot of commissions, they simply ignored the risk officers, and so we had the problems that we had. Okay? A lot of small companies can't afford to have a person who does this full time, so they outsource the position, and there are consulting firms that do it, and also it is a service that's provided by the insurance companies. Okay? And again, I spoke with this one student. I talked to him yesterday about setting up a Zoom meeting with his dad. Once we can count on Zoom, then we'll have his father, who's a risk manager for Zurich Insurance Company, Zoom in with us and describe what he does for a living, what he does every day as a risk manager, a consultant for a large insurance company. All right, whoops. So the job of the risk manager includes financial risk. In the past, it did not include financial risk. So there are 4 common types of financial risks that firms face. Okay? Commodity price risk, and we're going to go into detail on each of these. Okay? Commodity price risk, stock price risk, interest rate risk, and currency risk. Okay? And so we're going to drill down into each of these, starting with commodity price risk. All right, so let's say that you're a farmer and we get a lot of students at Harding who come from family farms. Okay? So you're a corn grower and you estimate in May that you're going to harvest 20,000 bushels of corn. Now, it's in May, but you're forecasting forward to December. Okay? And you think you're going to have 20,000 bushels that will be available for you to sell. Okay? The price on futures contracts for December corn is $4.90 per bushel. Okay? So each contract trades 5,000 bushels. Okay? So how can you hedge? So you look at that price and you say, I like that price, and I want to lock it in right now. Okay? And so you want to protect against a drop in the corn price. What might happen between now and December? This price is acceptable to you. Of course, you'd love to get a higher price, but you want this price. And so how can you lock it in today? All right? So you could sell 4 contracts. Since you own the commodity, you would sell a contract, and you're trying to lock in your price. You sell the contract, which means you agree to deliver 20,000 bushels to the buyer of the contract, okay, in December. and you sell at $4.90. Okay? So 20,000 bushels at $4.90 a bushel, 98,000 is the price that you agreed to. So there's someone on the other end of that contract, the buyer of the contract, and they are trying to lock in their price as well. Maybe you're talking to Tyson Foods. Tyson Foods is here today, okay? Well, corn is the single largest food cost that Tyson Foods has. That's the main thing that they sell, that they feed to chickens, okay? So Tyson wants to lock in $4.90, and the farmer wants to lock in $2.90. So the farmer sells the contract, and Tyson Foods buys the contract, and they're happy because they know what they're dealing with now. Okay, in December, you have two choices. You can deliver, if you're the owner of the contract, you're the seller of the contract, you can either deliver the corn or you can cover your position. So you can go into the market and you can buy contracts to what's called close out your position. Now that's probably not what this guy's going to do. What this guy's going to do is he's going to deliver his corn, or she will deliver her corn, okay? But you could buy 4 contracts to offset your position, okay, and that's called closing out the position. And regardless of what the price of corn does between May and December, okay, the farmer locks in $98,000. Well, let's look at what could happen, okay? So, and again, this is not something that risk managers used to deal with, okay? They used to be insurance people, okay? Let's look around and see if there are any saws that don't have guards on them, or if there's an oily rag next to an open wire. Okay, that's what they did. Now it's a much bigger job, and they're working with different departments to try to figure out what are the risks and how do we deal with them. Okay. All right. So you could sell. Let's say that the price of corn. This thing will back up. The price of corn drops from $4.90 to $4.50 from May to December. So this was the fear that the farmer had. And so the farmer's thinking, ooh, thank goodness I locked in at $4.90. I'm getting 40 cents a bushel more. Now, Tyson Foods is probably unhappy about it, you know, because they're going, man, if I just waited, I could have bought here, but I paid this. But they wanted to lock in their price. They wanted to deal with certainty, okay? So you sell your bushels for $4.50, and you get $90,000, but here's what your contracts are worth. Okay? You made a gain. You're able to go in and buy the contracts for $90,000. So you made a gain. You sell your corn for $90,000, but you make a gain. You close your position out. You sold them for $98,000. You bought them back to cover it for $90,000. You make $8,000 plus your $90,000. You've locked in your gain. Okay. All right. Now let's look at what happens if the price goes up. All right, if the price of corn rises to $5 a bushel, okay, you would sell your 20,000 bushels for $100,000, okay? You cover the contract at $100,000, okay? You received $98,000 for selling the contract. You'll have a loss of $2,000, but you sold your corn for $100,000, less the $2,000 loss. You locked in your $98,000. Either way, you're locked in. Okay. So people who actually use the commodity, Tyson Foods and the farmer, they're in the markets all the time. Okay, and this is really what I would call a legitimate use of futures. But speculators do the same thing. People who are not interested in the corn, okay, they're interested in the weather. They're interested in the demand for other crops. They're interested in how much corn will be planted. They're interested in what demand for corn looks like. And then based on all of those factors, they're going to bet not on corn, but on the price of the contract, based on what they think the price of corn will do. Anybody ever seen the movie Trading Places? Okay. Well, it was about commodities, and this was about, they focused on the orange market, orange juice. orange juice concentrate. And a commodities firm paid off a guy to get his hands on the government crop report. And they were given a fake report that said that a frost, an early frost, had damaged the orange juice market. And so they bet the prices were going to go straight up. Well, the real report said there was an early frost, but it did not damage the market. And prices went straight down and it bankrupted the firm. That's what the movie was primarily about. All right. So whether it goes up or goes down, you're locking your profit in. And so it is the job of the risk manager to make sure that either he or she or someone at the company is paying close attention to this risk that could affect the financial stability of the company. All right, and I would mention that trading commissions are ignored in this example, and trading commissions can be, in the futures and options, can be somewhat costly. Okay. Now in the stock market, trading commissions are going away. Firms are starting to eliminate trading commissions. Schwab has eliminated trading commissions. I think Fidelity has eliminated trading commissions. TD Ameritrade. Some of the discount brokers have eliminated trading commissions. All right, but not for options, just for stocks and mutual funds. All right, now let's look at an example of stock price risk. Okay, so you're at company A and you want to buy company B. Happens all the time. Deals happen all the time. Okay, and the way you decided to do it is you're going to buy the outstanding stock of company B. That's how you're going to buy the company. The other way you can buy the company is you could buy the assets of the company. Okay, and that's a cleaner way of doing it actually, but most often the deals are done stock for stock. All right, they plan to swap their stock, so company A is not going to give them a bunch of cash. They're going to issue new shares of their stock to the owners of company B, and they're going to say, here's our stock and you give us your stock. Your stock will be off the market because we're going to own all your stock, okay? And our stock will remain on the market. And typically they have a period of time where they can't, where the folks at company B who get company A stock, they're restricted. They can't sell their stock. They have to hold it for a certain period of time. All right, and they will use a fixed dollar value of their shares to buy a fixed number of the shares of the other company, okay? And so what they want to do is they want to lock in their price, okay? And they're worried that if bad news comes out about company A, that company A stock could go down. And if company A stock goes down, they will have to issue more shares than they want. They might be issuing 10% of the outstanding float of their company to buy company B. But if let's say they have a bad quarter that comes out and the stock price goes down, then they might have to issue 15 or 20% of their shares to buy company B. Not because something has happened to company B to make it more valuable, but something has happened to company A to make it less valuable, at least over the short term. So they want to avoid that problem, okay? So how do they do it? All right, they can use options on either their stock or on company B's stock, okay? That will protect them against adverse price moves. All right, let's look. So they could buy a call option, and a call option gives the owner the right to buy 100 shares of stock at a specified price. Each contract, each call option contract, gives the owner the right to buy 100 shares. We just went over this in investments. Okay, and so this happens a lot. And it's the job of the investment banker to advise both companies on this deal. They're going to advise company A what company B is worth and how to structure the deal. And company B will hire their own investment banker who will advise them on what their company is worth and what company A's stock is worth and what a fair stock swap should be And both investment bankers will advise their clients on how to avoid risk or lock in the price. Okay? And they can also involve put options. And you can do what's called a straddle. You can buy and sell on both sides of the deal to lock in a certain range. Okay? So one option strategy would be to hedge against a decline. So in this case, Company A is worried that their stock is going to go down, which means they'll have to issue additional stock. Well, they could buy puts on their own stock so that if their stock goes down, the value of the puts that they own would go up to offset the problem. So they still would have to issue additional shares, okay, but they would have the profit from the puts that would make up for the shares that they have to issue, okay? All right, so that's how that would work. And once again, you know, the risk manager isn't the lead, isn't the CFO of the company. The CFO of the company is leading the charge on this deal, but the risk manager has to lean in and say, hey, make sure that you lock in the price. You've got to protect the firm against the risk of a stock move, either in our price or in their price. Okay? All right, what if the value of the stock of the company to be purchased increases? What if they announce a great quarter, or what if they announce a new product, or what if they simply announce the deal itself and people go nuts about it? Okay? So the buyer would have to, once again, issue additional shares to lock in the price. The buyer could buy calls. Now, once again, it costs money to do this. Buying the calls is an insurance policy. They might buy the calls to lock in their profit or their ratio, but nothing happens. Okay? Well, what happens at the end of a period when you don't exercise an option? They're worthless. So what the money that you spend on the calls, it's an insurance premium. It's going to cost you. Okay? So don't ignore that. All right, so if the stock goes up in price, the stock of Company B goes up in price, you'll make a profit on your calls that will cover the cost of the additional shares that you have to issue. Okay? All right. Here's another financial risk. Anybody in here take the commercial banking class? Okay. We talked about this interest rate risk that banks and lenders have. Interest rate risk. All right. This is the risk that an adverse change in interest rates would have on a business. Okay? So you ask yourself, if interest rates go up or down, how could that affect the business? Okay? Well, a prime example is a bank that originates mortgages. Okay? And there are all sorts of finance deals, financial arrangements that happen not only through banks, but just company to company, like accounts receivable, where somebody buys something and they don't pay for it up front. Okay? So, say the bank charges a fixed rate of 4% on a 30-year mortgage. Okay? So somebody goes in and says, I want to buy a house, I want to borrow $300,000, how much will you charge me? And you say, I'll loan you $300,000 for 30 years, payable monthly at 4%. Okay? Well, at the time they do that, they are funding that loan through CDs. But CDs have a 1-year maturity. This is a 30-year loan that is being funded by a 1-year CD. And it happens all the time. That's what banks do. They take money in short term and they lend it longer term. And banks have gotten a lot smarter about how to protect themselves against this. Okay? But one thing they do is called an interest rate swap. Okay, so the bank pays 1% on a 1-year CD. So if interest rates rise by 1%, okay, in that after a year, so they've locked in a loan for 30 years at 4%. That's what they're receiving, and this is what they're paying. Well, at the end of the year, interest rates go up by 1% on the CD, and now they're paying 2%. Well, the profit margin on their loan went from 3% to 2%. That's a big drop. Okay, that's a 33% reduction in their profit margin. Most companies would have a hard time recovering from that kind of a drop. Now you say, well, it's only 1%. No, it's not. It's 1 percentage point on a 3 percentage point profit margin. It's a 1/3 drop in the profit margin. It's big. Okay, so banks dreamed up, Wall Street dreamed up this derivative, this contract called an interest rate swap, an IRS interest rate swap, so that banks can hedge against this type of risk. It helps banks quickly manage their portfolio of loans and their portfolio of how they fund loans. Okay? So an interest rate swap is a contract between two lenders, two banks, who agree to exchange their cash flow streams, okay, to balance and diversify their portfolio. So how does this look? Okay, and we can get into the tall weeds, but we're not going to. We're going to take a higher altitude look at this. A bank that has too many fixed rate loans or long-term loans, they're uncomfortable with locking loans in at 4% for 30 years. They've originated too many of those mortgages, and they're concerned that short-term rates will go up and damage their margin. Okay? So they can look for a bank that has the exact opposite problem. Their loans are short-term, adjustable rate loans. They're worried that they have too many short-term loans and that they have too many adjustable rate loans. So they both have problems. They're opposite from each other. So they agree to a contract that swaps the cash flows and the risks. So Bank A, that is worried about too many long-term loans, receives the cash flows from the short-term loans, and Bank B, and has the risk of the short-term loans, and Bank B swaps their short-term loans for the long-term loans via a contract. So they're not actually swapping loans, but they have an agreement that identifies certain loans and amounts that allow them to modify their portfolio. Once again, it's the job of the risk manager to talk to the bank portfolio manager and to let him or her know, we got a problem, we've got a big exposure with our long-term loans, and the regulators came in and looked at our portfolio. They did a stress test on the portfolio. If short-term rates go up 1%, we're going to go from making $5 million a quarter to losing $300,000 a quarter. We've got to lower our risk in those areas. So let's do some interest rate swaps. Okay. All right. Lastly, there's currency exchange rate risk. Okay. Currency risk. So when you're doing international business, you've got this. Currency is the money that a country uses in their economic system. Okay? If you're doing just domestic business, this doesn't apply to you. You know, if you're a local business and you're selling to people in your state or just in your town,